Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining me. On the show tonight, we have Mike Gable looking at some very interesting resource stocks, and he particularly likes Fortescue, and we'll see why. Paul Rickard will look at the Aussie dollar and where it's heading and what that could mean for your investing. And we'll also catch up with Grant Straker of Straker Translations, who uses AI for some very interesting applications. This could be an interesting company, no recommendations, but we are all looking for companies that can benefit from the growth in artificial intelligence. Now, just before we go to Mike Gable, I want to make the point, a lot of people are afraid that because US might be going into a recession, and most analysts think it may well be not going into recession, particularly 2023, but they think that the S&P 500 has rocketed along so much that it's kind of unlikely that it can go any higher. But the reality is the Magnificent Seven, those top stocks like Meta, Apple, Amazon, Alphabet, all those have really ripped along. They're up about 53, 55%, but the S&P 500 is only up about 12, 13%. And if you took those big seven out, S&P 500 is only up 0 to 2%, not much at all. So there's a lot of potential for the US stock market to really do well, particularly if the Fed either says it's not going to raise interest rates anymore, or the belief is that they're near the top and there won't be many more, and maybe in 2024 they'll expect some interest rate cuts. All that means that the S&P 500 can go higher without much gambling that, a lot of it's already been done. A lot of it's been done by 7 companies, but there are 493 other companies in the S&P 500, which, and many of them haven't moved much at all, if they may have even gone backwards. So they're sort of primed to do well when interest rates come off the boil. That's one reason why I'm pretty positive about the stock market going forward, because if Wall Street does well, the Australian market is bound to pick up some benefit from that as well. So look, let's kick off now with Mike Gable of Fairmont Equities. Thanks for joining us, mate.
Thank you.
So let's go to the way we always start this little get together between you and me is look at the big picture, S&P 500, what's it saying?
Looks great.
I love that.
It's confusing a lot of people. I think, it doesn't make sense to a lot of people that the market's going up, but I think, too many commentators or investors are just focused on what's happening right now as opposed to having a proper outlook as to what's going to happen next. And, there's still a lot of bearishness out there. There's, fund manager surveys are showing that there's still a lot of cash on the sidelines, and the consensus is that there will be a recession, and the recession will lead to drops in the share market. But clearly the market's looking beyond that. We've seen with the New Zealand market that's now officially in recession, but recession is looking in the rear view mirror, and the New Zealand share market in the last few days hasn't collapsed on the news that it's that they've had a recession. So it's confusing a lot of people, but the price action, as we've mentioned all year, has continued to look positive. So if I comment on the actual chart itself, in terms of some key points, when I was here last few weeks ago, we were looking at the way it was consolidating under this high, and I expected a break up towards 4,300, but it's even exceeded sort of my short-term expectations. But the key takeaway with this chart is that the downtrend has been broken, and it's trending higher. So there is absolutely nothing wrong with the way it's trading.
And Mike, one of the points I made earlier before you came on the show was basically a lot of this growth has been driven by the Magnificent Seven, the top 7 stocks. The overall S&P 500 is only up 11% or 12% now, maybe a little bit higher. But if you take those 7 out, the S&P is only up 0% or 2%. So it's got a lot of upside. It's not like the whole S&P 500 has gone rapidly. been driven by 7 stocks mainly. So the rest had plenty of room to go higher.
Yeah, exactly. And it's funny you make that, because that's the same point that I've been making. I think a lot of people are looking at the negative view, which is, well, there's only several stocks making the market go up. But if you're of the opinion that the market shouldn't be up, okay, take those several stocks out, and it's flat, as you say. So it's got the upside. Ideally you want market breadth to be more healthy, but just because those several stocks have lifted the market up doesn't mean that they're due to fall and the market's going back down. The flip side is those other stocks may well be ready to start recovering as well.
If interest rates top out, I'm sure a lot of those companies will start being bought on the basis that rates will probably fall, and they were sold off because rates were rising. So let's hope we're right. Let's go to the Aussie market now. There's the S&P ASX 200.
So, I mean, our market, in the last several weeks, it's lagged the US market. Obviously, we've got a lot of resources, and resources have not kicked on in the past several weeks. But now it looks like our market is going to recover. So, in terms of charting, we've had that sort of oversold condition. If we look back at the last few months, we got the bounce that we're expecting. And then you have this consolidation. So this is known as a bull flag, quite simply because this looks like a flagpole and that looks like a flag.
Yeah.
And what's really happening is you get a strong move up that happens very quickly, but then you need all of this time. It's about 7 or 8 weeks here where the market's trying to sell off, but clearly there's been a lot of buying of the dip. So you end up with a move that's not really too steep on the downside. Last few days we've seen a break of this flag, so I expect the market to move back up towards this 7,600 level. And as I've mentioned before, I think there's a good possibility our market will have an 8 in front of it within the next 12 months.
Well, I hope you're right, mate. Let's go to some individual companies now. First one is LTR, Liontown, which has had a rip-roaring run lately. Is it still looking positive?
Yeah, I mean, in terms of the chart, still looks fine. I guess, we have to consider the fact that you've got a bid on the table. I think it's at 250 and it's trading higher than that. But firstly, you've got the market trying to price in the potential of another bid, but also we've got lithium prices heading back up, and most lithium miners are seeing their share prices head up. So it's not as though it's just Liontown's share price getting a little bit too ahead of itself. The whole sector is it looks like it's gone from being oversold to recovering. So it's just what would I do? Look, I'd be tempted, if you've got a bid at 250 and it's trading at $3, I'd be tempted to take this off the table and move into maybe one of the other lithium miners that could have more upside, at least in the short term. But I'm still bullish the resources sector, and I think after the last few months of sort of soft price action, just generally in the commodity sector, I think that bearishness had reached an extreme point a few weeks ago, and I'm expecting these to continue to recover.
Okay, let's go to IDP Education, IEL. Has been really sold off. A bit of a buyback from people who believe in the company. A lot of fund managers do. What's your take on what you're seeing?
I'd just be a bit cautious on it now that it's recovered up to these levels. So even before this large drop, you could say that there was an area of support near $26, and a few days before this announcement here, it actually broke support. So it was already getting sold off before this announcement. But
I wonder if some people knew in advance.
No, of course not.
Of course not. Okay. That couldn't happen.
But what you've seen, thankfully, if you are holding the shares, is a nice sort of bounce back up. But what you'll find is, because you're getting very close to where it was before that large drop, those who wish they were just out of it are starting to sell it. So price action here on this particular day is showing, quite a bit of selling come in, near $25. To me, it does look as though this bounce is sort of petering out, and I expect it to be moving back into, sort of the $22, $23 region. So look, it may well be heading higher in the long term, but I think over the next several weeks, I don't expect too much from this share price.
Okay, let's go to Vulcan Steel, VSL.
Yeah, so look, a fairly volatile one. I'd say the risk to this is still on the downside. So we've had these sharp sell-offs. And what I've noticed is, again, recently, this particular candle on this chart is showing price rejection. So what you're getting is every time it tries to rally and it gets anywhere near a previous high, the selling kicks in, and that's happened again. So we still have a downtrend in this one. And unless it can move beyond this sort of 820, 830 region, I'd say it looks like it wants to, slide back into the, lower to mid sevens.
Okay, continuing our resources theme, Arafura Rare Earths, ARU, was doing well, now looks like it's under a bit of pressure.
Yeah, it is, and I think it will stay under a bit of pressure just for a little bit longer. So what I'm looking at on a chart like this is, again, how powerful the moves are on the way up and how, I guess, powerful the selling is on the way down, and just seeing if there's a difference. So this is a weekly chart going back a few years. When a stock looks bullish, you get very strong moves very quickly on the way up. And then when it is time for people to start selling it, it takes a while for the share price to head back because there's a lot of buying of the dip, and it doesn't fall back too steeply. So we've seen that on a number of occasions. So during 2021, we could see the very strong move up here, and then the sell-off was fairly flat in comparison. A sharp move up here, another sort of fairly flat period of selling. So we've seen that happen on a few occasions. There was one occasion here in 2022 where the sell-off was, for the first time in a while, actually quite sharp. So what that means is it takes a longer period of time for ARU to get ready to get going again. So it needed sort of 6 months in the wilderness here of doing nothing before it could continue on. So once again, we're seeing a sharp move down. So even if maybe in the short term you might get the odd bounce here that looks impressive, I think because of this sharp move down, we may end up with a situation like this where you get some bounces along the way, but I wouldn't be surprised if 6 months from now it's still banging around that.
So a sustained period of sort of bottom bouncing.
Yeah.
Okay.
Yeah.
Let's go to Boss Energy, BOE.
I think this one looks really good. I know that's hard to tell because it's a very messy chart, but what I'm looking at is, we have a period here where this trading range, and it was quite a large range, about close to $2 to almost $3, but it was in a bit of a range, and we can see that there's this area here around $3 where every time it went up there was clear selling. And what's very interesting now in the past few weeks, this is a weekly chart, is it finally got through that wall of selling. So whoever wants to sell Boss Energy has done so, and it's managed to break to the upside. And even in the short term, it's come back towards that breakout area, but that little dip was bought up. So I think this one can head substantially higher, and over a long period of time, and that's because you have this trading range here that lasted about 18 months, which means this move should be a multi-month move. So
seems like a big commitment around that price range.
Yeah, so that's a fairly major sign, and we could see even back in sort of 2020, 2021, previously there was a bit of a range where there was a cap on the share price, and once you got through that, over many months you had a a fairly decent move. So I think you'd get something similar in this one.
Okay, let's go from minerals to 60. It's a smallie, but is it showing a bit of positivity?
Yeah, they're very, very volatile. As you know, the daily ranges are quite large. So I guess a tricky one to trade. I suppose what I could take from this chart is we do have the higher, a few higher lows and higher highs, so generally heading in the right direction. Most recently, there seems to be a little bit of a ceiling at 50 cents. So, maybe it turns and goes all the way back down towards 40 cents again. But basically, if that's your trading range, you have to be prepared that if it breaks under 40 cents, that's a negative sign. You'll have to sell it. But if it breaks above 50 and all those sellers are cleared out, then you can add to your position or even look to that as a buying opportunity.
So if you got into this at a reasonably low price, would you be a keeper?
Yeah, I'd be sticking with this overall trend.
Riding with the trend. Okay, let's go to Chalice, CHN.
So uptrend, sort of on a longer, in terms of a 12-month view, we can clearly see that uptrend. If you're looking at it on a much shorter time frame, say just in the last few months, then clearly it's got a bit of a downtrend. So we've got a short-term downtrend, but a longer-term uptrend, and then it comes back to your time horizon. Really, if you're a bit of a short-term trader, you wouldn't be touching this because it is on the way down. But if you're a bit more longer-term, you just deal with these big swings. Again, looking at the size and the timing of the moves on the way up and down. So once again, very quick move up, and this pullback was over a longer period of time. Again, very sharp move up. So this looks like it within the space of a month. It went from $5.50 to $8. But now it's taken 2 months to get it back under $7. Still nowhere near $5.50. So the bulls are still in control longer term, and
bit of profit taking.
It's just a case of just trying to pick your entry point. I think if it got closer to about $6.50, you could buy it here and know that that's your stop level.
And also, Mike, that also coincides with a time when other big miners were under pressure as well, weren't they? Yeah. So it's all quite understandable. Let's go to your pick, another miner, FMG, Fortescue.
Yeah, so look, I think this one looks great. I mean, when I was on the show, I think 3 or 4 weeks ago, I was looking at BHP as the stock that I liked, and we know that the reopening in China has been a little bit disappointing so far this year, but the point that I made a few months ago was the bearishness around iron ore miners and resources in general just seemed a bit too much. It just seemed as though we're getting to it was reaching sort of fever pitch levels.
Yep.
And it reminded me a little bit of November last year, where a lot of people seem to be giving up on the iron ore stocks only for them to rip higher, and that's what we saw here with Fortescue. And I spoke about the prospect of Chinese stimulus because their CPI was so low. They have the ability to do that and not cause inflation. So we are now starting to see that. So it seems as though the lows in the iron ore miners was a few weeks ago when everyone was quite negative, the sector, and they've turned around quite strongly. So what I've got here is a weekly chart of Fortescue. And again, if we look at the timing of moves, since the peak earlier this year, thereabouts, near $23. So Fortescue's eased back over 5 to 6 months, but we could see that it's almost recovered all of that just in the space of a few weeks, and the volume's been pretty high as well. So this bounce in Fortescue looks very, very bullish. And looking at the longer term view, you've got this very clear level near $23. So it's tested it on multiple occasions. So clearly there's a lot of sellers at $23. So what that means is if it gets above 23 and we're looking at a share price sitting up here, we know that the sellers are gone, and it'll be up at $26 before you know it. So I think in the next few days, Fortescue might just track sideways a bit, but I'm pretty confident it's going to get through $23 soon, and then you're looking at $26.
So it's like Gable's taking on the analysts, because the analysts are against it, but they've been wrong before.
Oh, look, when it comes to resource stocks, you need to, you almost need to do the opposite of what the analysts are saying. I think they're quite slow to update numbers, and the iron ore price can move pretty quickly, and this sector can move pretty quickly as well. So, when I see they all hate a particular stock, that actually gets my attention.
Okay, that's Mike Gable, Fairmont Equities. Well, in recent weeks, we've seen the $dollar creeping up, and Paul Rickard has a view on the dollar and how you should invest as a consequence. Paul?
Yeah, great week for the Aussie last week, Pete, up over 2%, one of the best performing currencies. And I guess there are three things driving it. First of all, an expectation maybe US interest rates have peaked. I mean, they left the door open for perhaps another couple of increases later this year, but I think the market sort of feels that the Fed is pretty close to the process. Secondly, I had expectation that Aussie rates are still going higher. It's probably been the biggest driver, Pete, and I guess Phil Lowe's got a couple of meetings left in him.
He has.
July, we've got 3 meetings potentially. And then thirdly, I think we got a bit of recovery in commodity prices on the back of perhaps China overstimulating. And I guess you and I have been waiting to say the Aussie dollar is going to finish its sort of its fall, because it is, in all metrics that we look at, below where it should be on a sort of a, historical real cost basis, which is somewhere between sort of, I guess, around about 75 cents is a good barometer for the Aussie dollar. But in the sixes, and it hasn't been so strong. So I think it is time to almost feel that the Aussie dollar has, the downside is almost gone. And to start playing the Aussie dollar from the long side.
Yeah, and we've been encouraging our clients to be hedged because we thought the dollar would go up. It's not too late to hedge, Paul.
No, it's not. It's a pretty riskless strategy too, because you're not reducing the value of the assets. You're only just cutting out the losses in case the currency goes the wrong way. For in the old days, it used to be quite expensive to hedge, and that's why we used to caution people about hedging, and that was because the cost of the hedge is largely an interest rate differential, and traditionally, Australian interest rates were a lot higher than US interest rates, so it actually cost quite a bit to hedge. For the last 3 or 4 years, we've had the reverse situation where US interest rates are actually higher than Australian interest rates, so actually it doesn't cost anything to hedge at all. And that is still the case today. So that's one of the reasons where our dollar's been weakening. And I think that's sort of coming towards an end. So hedging is a pretty costless strategy. Of course, what it does do, Pete, it limits your upside should the currency fall.
Yeah, exactly.
So that's worth pointing out.
And that's the gamble. The gamble is that we've been in a period of low Aussie dollar. It tends to trend up, and also when America gets to the top of interest rate rises, you kind of expect the US dollar to fall, which will help us. And also, the US budget deficit is very big, and that's been historically a driver of the US dollar down. And America wants the dollar down so they can actually do better on trade.
Well, and it does actually cost the economy. I mean, you saw CSL last week, which measures its sales and costs in US dollars, although it's an Australian company, it measures it all in US dollars. And one of the reasons behind its profit downgrade last week, Pete, was because of the high cost of the US dollar. In other words, it's got a very lot of costs in US dollars, but it's paying for the plasma. It's selling into Europe. It's 30 or 40% of its sales. The European currencies on average are weak because the US dollar is so strong. Therefore, it doesn't get as much back. So because it has to denominate the sales back in the local currency. So that impacts all the big US multinationals, who have global sales. So
okay. Well, that makes me think then, if the US dollar does trend down over the next year or so, you'd expect that to be an help to a company like CSL.
Yeah, look, it should be. I mean, and you're right. I mean, I'm just saying that there is an economic cost of having a very high currency, and it makes exports less competitive. And so, that's one of the reasons. So you were saying as well that the US dollar, US government, it's not as though it's running a small budget deficit; it's running a huge deficit. Right? So fundamentally, the US dollar should be a lot weaker.
Yeah.
That just hasn't been because that's been leading the charge up in interest rates.
Yeah, and so one of the reasons why when I play the US market rather than going for IVV, which is a very cheap way, I go for IHVV. But if I thought the dollar was going to fall, I'd probably switch to IVV.
Yeah, and so I think that brings to the question: what can you do about your investments if the currency is going to rise? Then that's going to take away from any gains in terms of offshore investments that aren't hedged.
Yeah.
So I think a natural thing is to look at the hedged variance, and there are some products you mentioned, IHVV, which is the iShares index fund that tracks the S&P 500. That one's the hedged version.
Yep.
There's an unhedged version, IVV. So if you hold IVV, you could potentially switch into IHVV. And there are a few other ETFs that offer hedged variance. So that's the first thing I would do, is get the proportion of hedged funds up. There are also some active managers, not many, but who have a hedged product version, and so you can switch or look at the active manager. I guess for those who are holding US shares directly, there's pretty hard to do anything about that.
Yeah.
And also, it probably will impact to some extent some of our Australian companies, particularly those that have very, very big US dollar earnings. So it's probably not a positive for CSL, and you can argue it's less of a positive for some of our big miners on a rising dollar. But maybe at the same time, it does make their shares arguably a little bit cheaper for people from offshore. So I don't know. Yeah. You can play it both ways, but it tends to, when the Aussie dollar is getting strong, the CSLs of this world tend to get pulled back a little bit because of the appreciating currency. So it is hard to eliminate the risk out of your portfolio.
Yeah, exactly. Thanks, Paul.
Thanks, Peter.
That's Paul Rickard of the Switzer Report.
Thanks for joining us.
Great to be here.
So, mate, before I start looking at the business as such, why don't you just tell us what your business actually does so people watching this can understand it?
Sure. So we operate in the $50-60 billion US localization industry. So that is an industry that is translating and interpreting different languages for corporate, business, personal needs. And so what we do is we have a technology platform that provides the translation, but it's an AI enhanced translation technology. So it's based around productivity. So we make the humans more efficient, and that provides a much lower cost for our customers.
And give us a classic example of how your business operates and helps other businesses that use your service.
Sure. So look, I mean, the big one, I guess, our largest customer is IBM. So we do everything for IBM globally. And so they are using us to automate the flow of content out of their systems so that it can be translated into multiple languages and they can engage with their customers. So this content covers everything from technical type content to marketing type content to internal conversations. And so it's very much about taking all of the information that they have, automating the process for that content to flow through. To actually, we also have technology that enables them to utilize it inside the tools that they use every day, so they don't have to go into another portal to try and figure out how they're going to change all this. So we make it very simple for our customers to manage what has traditionally been quite a complex process.
Okay, so what's a classic example of a customer who you work with?
So we have thousands, but a classic example might be somebody like Seat, perhaps a car manufacturer, where they release a new car, and that needs to have the technical documentation for that car translated into 20 languages. It needs to have the marketing material that's going to go with this new release of a car translated on the website, and in terms of the brochures, it needs to have the training for all the technicians around the world translated. So again, there's 3 different areas there, but they're all going to use common terms, and so there's a central repository of information and rules that ensure that each part of that business is consistent.
Yeah, okay, so obviously the people who are watching this are going to do what I did when I decided to talk to you. They'll go to your web, they'll go to the charts of the stock market and for your stock, and they'll see it's down about 30% year to date, but the last week or so it's up about 5.7%, while the Australian market's only up 0.75. Are you getting a little bit more interest in your business because you do use AI?
Absolutely. And I think that's, right now there is I guess you've got to decide with your business, what side of the fence are you sitting, and investors have got to decide that. And we've always said we're an AI language technology company, and we've spent, a decade or so building technology that leverages AI. So it's no surprise to us exactly what's happened with AI. It's suddenly become into the general consciousness that this stuff is really powerful. And so because we're based on productivity, that's the whole point. As AI advances, so we can translate more, but at the same time, there's a lot more content to translate because suddenly AI is generating all this content too. So I think that has played a part. And a big mission for us.
Okay, so what are the challenges for the business? You're in the right space at a time when the market's looking for AI companies. Obviously, your service is valuable in many ways. What are the challenges for the business to go to the next level?
So, well, I think what's happening is that generally there's a global sort of technology-driven change for a lot of businesses. So one of the things that we've got right now is we know exactly what customers need and how I will help them. It's just waiting for those customers to get that recognition themselves. So, again, what we've done for the likes of IBM or, Nike, a big customer of ours, the European Commission, these sorts of customers, they understand what our technology can do. When we've traditionally gone out and tried to get a customer to switch, and we can say, look, we've saved this customer X amount and we've got this AI driven stuff, they didn't really sort of go, right, okay, I need to do that next week, because they trusted their supplier and they weren't sure it would give the benefits. Now that there's this huge awareness of how powerful this is, the challenge for us is to be front of center as these companies start to go and look for new providers. So that's a big focus of ours. And one way we're doing that is we've integrated in with Microsoft Teams and with Slack, 2 very common workplace tools that are used by millions of organizations. So we're rolling that out. And so that will be the first part. I think other than that, it's much more around the opportunity than the challenges, I think.
Okay, mate. Well, best of luck going forward. You're in an interesting space, and at the moment, the market is liking what they're seeing. So good luck with the future.
Thank you very much. And great for having me on. Thank you.
And that's the show for tonight. Thanks for joining us. Remember, if you want more analysis and better insights into what you might invest in, have a look at the Switzer report. Go to switzerreport.com.au. Thanks for joining me. See you next Monday.